You tap your card. 2 seconds later, the screen says approved. But nothing has actually been paid yet. The money won't move for another 1 to 3 business days. And when it finally does move, at least 4 companies take a slice of your purchase before it ever reaches the store you bought from. Here's the part almost nobody understands. One of those companies doesn't lend you $1. It doesn't hold your deposits. It doesn't lose a cent when someone stops paying. It just counts the cars going past, and it keeps one of the fattest profit margins in the history of capitalism. It isn't your bank. And that gap between who takes the risk and who takes the toll explains where all the money in this industry actually sits. Because credit card company isn't one business. It's 3 completely different businesses wearing the same coat, and only one of them is a money printing machine. In the next 12 minutes, I'm going to walk you through what actually happens when you swipe, the 3 businesses hiding inside that swipe, and the company that just spent $35 billion to stop being one of them and start being another. That last one is the part nobody saw coming. Stay with me. The swipe. Let's untangle who's in the room. There's you, the cardholder. There's the merchant. There's the merchant's bank. That's the acquirer. There's your bank, the one whose name is on your card. That's the issuer. And in the middle, there's the network. Visa, Mastercard. When you tap, the terminal sends a request to the acquirer. The acquirer sends it to the network sends it to your issuer, and your issuer decides in about 20 milliseconds whether you're good for it. That answer travels all the way back. Total round trip, 1 to 3 seconds. That's authorization. It's a message, not money. The money comes later. Transactions get batched, usually at the end of the day. Then the network reconciles who owes what, and the funds move, typically 1 to 3 business days after you walked out of the store. So the approval is instant. The payment is slow. And in that gap, everybody takes their cut. Now let's look at who they are. Business 1, the issuer. This is your bank. Chase, Citi, Capital One. And here's the thing. People get wrong immediately. This is not a payments business. It's a lending business that happens to hand out plastic. An issuer makes money 3 ways. Cardholder fees, annual fees, late fees, foreign transaction fees, a slice of the swipe fee, and interest on the balances you carry, which is the one that matters. Let me show you what that looks like with real numbers. The Federal Reserve puts the average rate on accounts actually being charged interest at 22.15%. Say you're carrying $1,000 at that rate, and you pay $30 a month. You'd think a $1,000 balance takes a couple of years. It takes 53 months, 4.5 years, and you'd hand the bank roughly $568 in interest to clear a $1,000 debt. That's 57% on top, for one purchase you probably forgot about. And that's the optimistic version. Real minimums shrink as the balance shrinks, which drags it out further. Americans are living in that math right now. Credit card debt passed $1.2 trillion at the end of 2024, and according to the CFPB, the share of cardholders paying only the minimum hit its highest level since at least 2015. So the issuer looks like a fantastic business. But here's what's uncomfortable. The issuer is the only player at the table who eats the loss. When someone stops paying, the bank doesn't get to send that bill to Visa. It writes it off. The charge-off rate on credit card loans across U.S. commercial banks was running around 3.8% in early 2026. In the first 9 months of 2024 alone, issuers wrote off about $46 billion in bad card debt. And now the part that genuinely surprised me in the research. You'd assume the swipe fee is a fat profit stream for the bank. It isn't. The CFPB looked at what issuers actually keep after they pay the network and pay out rewards. And the answer came to about 0.3% of purchase volume. 0.3%. Your 2% cashback isn't a gift. It's the swipe fee handed back to you to keep you swiping, which means the transaction side of your bank's card business barely makes money. The profit is in the lending. The rewards are the customer acquisition cost. Business 2, the network. Now the toll road. In its 2025 financial year, Visa did $40 billion in net revenue and took $20.1 billion of that home as profit. That's a 50% net margin, half of every dollar in the door. It did that while processing 257 billion transactions, connecting nearly 14,500 financial institutions across more than 200 countries. Mastercard, running the same playbook one size smaller, 32.8 billion in revenue, 15 billion in profit, a 57.6% operating margin. Now hold those next to a bank. Visa's return on assets is around 19%. A well-run bank earns about 1%, because Visa barely has assets to put at risk. It doesn't fund your purchase. It doesn't carry your balance. It doesn't own the loan. It owns the road. But here's what everyone gets wrong. This is the part that changes how you see the whole industry. The swipe fee, interchange, the 1% to 3% merchants complain about, is not Visa's money. Visa and Mastercard set the rate, but the money goes to the issuing bank. You don't have to take my word for it. It's written into the securitization filings banks submit to the SEC. Interchange is paid to card-issuing banks as compensation for taking credit risk, absorbing fraud losses, and funding the receivable before you're even billed. That's the whole logic. The bank fronts the money and carries the risk, so the bank gets the interchange. The networks charge separately and smaller. Service fees and data processing fees on the volume they carry. Here's the number that makes it land. US swipe fees on Visa and Mastercard cards came to $118.8 billion in 2025, according to the Merchants Payments Coalition. Visa's entire global net revenue that year was $40 billion. The fee everyone blames Visa for is nearly 3 times Visa's whole business, and Visa doesn't collect it. Business 3, the closed loop. Then there's the third model, where one company is both the network and the bank, American Express. Discover. Amex issues your card, runs the rails, and bills the merchant directly. No interchange, because there's no one to pay it to. That sounds strictly better. Look at what it actually does to the numbers. Amex booked $67 billion in revenue in 2025, 68% more than Visa. And it earned $10.7 billion in profit, roughly half what Visa earned. More revenue, half the profit. That's the trade. Amex owns more of the transaction, but it also lends, so it carries a balance sheet and eats credit losses like any bank. Its answer is to go premium. $1.67 trillion in card member spending, and nearly $10 billion a year in card fees alone. If you watched our video on the Centurion card, that's this strategy at its most extreme. The $35 billion tell. Now the part I promised you. If the toll road really is the best seat, you'd expect somebody to try to buy their way into it. In May 2025, Capital One closed a $35.3 billion acquisition of Discover. Capital One was one of the largest card issuers in America. Business 1. Discover was one of only 4 US card networks. Business 3. And here's the mechanism, which is the sharpest thing in this entire story. The Durbin Amendment, passed in 2010, caps what large banks can charge merchants on debit, about 21 cents plus 0.05% per transaction. But when the Federal Reserve wrote the rule, it concluded that three-party systems, where the issuer and the network are the same company, aren't payment card networks in the relevant sense. So the cap doesn't reach them. Own the network, and the price control disappears. Capital One moved roughly 25 million debit cards onto Discover's rails. Its own investor deck valued the network gain at $1.2 billion a year. As of its July 2026 earnings call, that migration is complete, and it's now testing moving credit cards over too. That's the biggest issuer in America looking at the 3 businesses and voting with $35 billion. And it's spreading. JP Morgan, Bank of America, and Wells Fargo have all reportedly looked at buying debit networks of their own to run the same play. Now here's the honest counterweight. I've made the toll road sound untouchable. It isn't. On June 9, 2026, a federal judge gave preliminary approval to a $38 billion settlement between Visa, Mastercard, and about 12 million merchants, ending maybe a case that started in 2005. Swipe fees get cut by 1/10 of a percentage point for 5 years. Standard consumer rates get capped at 1.25% for 8. And the rule forcing merchants to accept every card in a brand goes away. Merchant groups say it's nowhere near enough. Analysts expect appeals that could run to 2029. Meanwhile, the Credit Card Competition Act was reintroduced in January 2026, endorsed by President Trump, and would force big issuers to put a second, non-Visa, non-Mastercard network on every card. It hasn't passed. It's been trying since 2022. And this pressure has a price tag. Visa took about $2.5 billion in legal provisions in its 2025 financial year, enough to pull its reported operating margin down to roughly 60% from the mid-60s. The banks have a real defense too. Somebody has to absorb the fraud, front the money, and eat the losses when a borrower stops paying. Interchange is the price of that. Cap it hard enough, and the rewards and some of the credit go with it. Let's zoom out. Strip away the plastic, and this is a story about two kinds of money. Lending money is a risk business. You put capital out, you hope it comes back, and sometimes it doesn't. You get paid for danger. Tolling is a rent business. You don't own the cargo, you own the road. You get paid for position. Markets know the difference. Visa is worth somewhere around $680 billion. More than every bank on earth except JP Morgan Chase. On $40 billion in revenue, JP Morgan runs $4 trillion of assets to get where it is. Everyone thinks the credit card business is about lending you money. It never was. The real money was never in the loan. It was in owning the road the money travels on. So here's the question I want you to sit with. In your own industry, the one you work in every day, who's taking the risk and who's quietly collecting the toll? Tell me in the comments. I read them.